Ben Nelson here with another episode of the Every Real Estate Investor podcast. Thanks for tuning in and taking a listen. So it's always fun to throw these ideas out there, and hopefully what you're hearing is inspiring, and you're learning a lot, and you're using these things to stop making those excuses and start getting out there and taking action and making things happen. Whether that's first getting your feet wet and getting into real estate investing, or scaling your business to another level, or whatever that looks like for you. So that's the goal, is to inspire those actions, make it happen, get past those excuses. Again, we're all busy. We're all that everyday person out there trying to have a family and whatever else we're doing that keeps us busy. But let's not let that keep us from doing our real estate investment activity and getting out there and getting in the game. So today we are going to talk about how to make money and what to do in a down market. Now, I'm going to say right now that I'm not admitting that we're in a down market necessarily, and we'll get into that here in a minute. But you can't help but look at the headlines and see all of the different articles out there about the housing recession and the pullback and sales numbers down, and prices potentially pulling back and doing so in some markets and things like that. So it's definitely on the forefront of the headlines. And so we're going to talk about it today and what that means in your real estate investing. So let's dive right into it and just go with the first with the concept of investing in general. So you got to think long term. You got to really think long term. And a lot of people get stuck in the mindset of more of a trader mindset and not an investment mindset, which is more long term, and what is your investment doing over time, and that sort of thing, and not I'm going to buy the whole buy low, sell high mentality of trading. Now, obviously, we all want to get the best deal that we can. It would not feel good to most people to buy something today and lose 10-20% of their equity or their value in over the next 6 to 12 months. Again, not saying that's going to happen, but of course that doesn't feel great. But if you have a long-term perspective, you have to understand that there are ups and downs in any market cycle, and you make a decision based on what you know now. You buy, and if you're buying for the long term, no, it is going to come back. We live in an inflationary system. There's ups and downs. That's just how it goes. And if you're in it for the long term, it really doesn't matter what it's worth at any given point in time, unless you're trying to use it for something else. If you're trying to re-leverage it, refinance it, obviously then it matters. But if you're in it for the long term, it really doesn't matter what it's worth a year or two from now. If it pencils now, and 10 years down the road it's going to be worth more, and you're going to continue to see that upward pressure on asset values from inflation, and just the overall pieces of the puzzle there. So really you got to get past the whole I have to time the market, I have to buy low, I have to make sure that it's going to go up over the next 6 months or a year. It may dip, okay, that's fine. Again, as long as you're buying soundly, and as long as you're you're able to cover your debt and think long term, that's really the goal here. So there's so many benefits. We're investing, right? We're not trading. You're going to have cash flow in the meantime. You're paying down debt. You're with amortization. You're going to get long term appreciation. You have tax benefits. So many reasons to own, other than just, is the price going to go up? And if the only reason that you're making money is because the price is going up, we all love equity growth, and we all love when there's appreciation, but that shouldn't be the only reason that you're making money in your investments. That should be almost icing on the cake. Your main motivation, buy for cash flow, that amortization is awesome if you're using leverage, which, I love leverage. It's a great tool. Not everybody buys that way. Some people do buy cash. They're just looking for steady cash flow and a solid return in that way, which is fine. But don't get stuck on just the value now and the value down the road. Yeah, you want it to do well, you want it to perform well, you want over time for it to grow, but don't look at it in short spurts, 6 to 12 month spurts. Look at it over the long term of the investment and what is it going to be worth down the road. So that's the first thing. Let's get our head around that. If you are buying something short term, because we do buy. I do remodel projects and flips. As an addition to holding properties. So there's nothing wrong with having that as being part of your business plan and doing that from time to time. Sometimes you force some equity, you turn it around. It's maybe not something you want to hold long term, but you can create some value there and make a little bit of money and then put it into something that you're going to hold. Nothing wrong with that. So just be conservative, right? If you're in an environment where it looks like prices could dip, pencil that in, right? Where we talked about having a successful remodel project a couple weeks ago, that is one of the things you want to pencil in contingency. So, for the unknowns, the what ifs, the things that is going to come up, you just don't know what exactly that thing is yet. So add another line item in your underwriting for, market, like for market depreciation. If you think it's going to go down 5% in the 6% in the 6 months that you're doing the project, pencil it in, add it in. And, you might lose more deals as we're shifting in a market, right? Because maybe people aren't paying attention to that and aren't penciling that stuff in. So you're not, you're being more conservative, but you know what? I'd rather be more conservative and not get a deal than back myself into a corner because I'm trying to be too tight in my numbers and I'm being too aggressive. So there's a balance. You don't want to be overly conservative, but you also don't want to be, overly aggressive either, especially in a market that has some nuances to it and is shifting a little bit and we're not sure exactly where things are going. So remember that. Oh, and actually, before I go on to this one, just be open when you're doing that and you're penciling that in. There's nothing wrong with being open with a seller if you're talking to a seller directly, and just be, they understand a lot. I mean, maybe they don't, but like educate them, right? Let them know, hey, we're in a market that it's not as competitive. Prices are starting to come down. Here's what I plan on doing with this property. Don't be secretive. I mean, we've talked about this before too. Like most sellers understand that you're buying it to make money. Okay, unless you're going in with some angle that you're being manipulative or you're coming at it from some angle that you're not being honest about what you're actually doing with the property. You're not saying you're an investor or whatever. I mean, if you're being honest and you're like, they understand you have to make money. This is what you do to make money. You're solving a problem that's worth something, right? So assuming that that's the conversation that you're having with them, just add to that and say, look, I got to carry this for 6 months and the market's declining and I think it's going to decline by this much over that time. So I gotta cut that now to make this work. And it may or may not work for them. But a lot of times they understand and they get it that, hey, this is the scenario that works for me to sell it. I understand that you're taking additional risk by doing this to it and holding it over this time. So yeah, that's fine. So be honest, just explain that and break it down to them. Underwrite diligently. So this is not, when you're in a market like that, there's been a lot of speculation and a lot of, just counting on these really, now I don't know that anybody penciled in 30% rent growth or, in any of their pro formas, but, people were getting really aggressive with what they felt like rent growth and price growth was going to look like in snatching up deals. And so, you got to stop doing that at this point. I think you're not penciling in, appreciation into, which I don't think you should ever do that anyway, but you're not penciling that in. You're pulling back on those parameters on what rent growth looks like, what price growth looks like, maybe even again backing it down into a decline over the next whatever your hold period is. But just underwrite diligently. Don't speculate. Look at real numbers. Buy based on what is and not what could be. That was a lot of that happening too. People understood they could go in and raise rents and all that, and the market was continuing to increase. And so, you typically want to pay for what is, especially in income producing properties. And when you're talking commercial financing and income approach to value and all those things, you want to buy based on what's there, not what could be. Lots of sellers were getting values based on what could be and not, what rents could be increased to and were going to be even future rents. When really, ideally, you're paying for what is based on today's values, today's cap rates, And then if you increase rents and make the property perform better, then you're getting the benefit of that increase in value. So, and the fortunate thing is if we have, if we continue to have a little bit of a slowdown, we're going to have more opportunities for that, because sellers could basically demand that because there are so many buyers looking for product, and now we're going to have less of that, right? So that means more ability to say, hey, look, this is what it is, this is what I'm willing to pay for it, and not necessarily overbidding based on, hey, well, it could have these numbers, right? Pick your market carefully. Pick your market carefully. I talk about this a lot in all of my market update videos and in a lot of my podcast episodes, that national and honestly, if you click on a lot of the titles or the headlines and you listen to these little 4 or 5 minute video segments, a lot of the experts say the same exact thing. The headlines don't say it. Every market responds differently. So there are so many factors. You cannot take the entire U.S. real estate market and say, this is what's going on in real estate, and this is how prices are being affected with mortgage rates, and this is how the economy is affecting the real estate market. It's just not relevant even. I mean, you're looking at the broader picture, but within that, again, you're looking at averages, right? You're looking at averages for millions of homes and just lots and lots of moving parts, lots of different little, lots of different metro areas, lots of different segments. And so you can't just look at an average, because there's so many different things within that average, right? What creates that average is all these different markets. So what you have to look for then is what are individual markets doing, and what are the markets that you're looking at or involved in? What are those markets doing, and how are those markets reacting to what's going on? And so you might have to shift, right? You might have been involved in a market that got a little bit too frothy, and prices are starting to pull back, and maybe you make a shift into a different market or a different asset class. Staying in one. If you watch good investors and you watch, whether it's stock, real estate, anything, they're constantly like reallocating, right? Because they're involved in one sector, one market, one whatever, for a certain amount of time while it's doing well, because they see opportunity. And then when that opportunity shifts or goes away, or another opportunity becomes greater, then they'll take their chips off the table and they'll move it over to another market or asset class or niche. So that's what you need to be doing, and that's what you need to be paying attention to. All markets were going up in the last, well, not all. There's always markets that are doing poorly, even in an upward market, and the opposite is true, right? So in a downward market, although a lot of factors, like macro factors, affect markets in general, every market's still going to have different outcomes to that, or be affected differently. Some are going to really pull back because of affordability, or other factors. People, were just moving there to get away from other areas, and those just not long-term sustainable drivers there, right? So you have to look at the big picture. You have to look at your individual markets and see what they're doing, and make an adjustment to a market that is going to last in the long term, or help you achieve your real estate investment goals, if the markets that you're currently in are not. So pick your market carefully. Again, every market's going to react differently. Make sure you're paying attention to those trends. Next week on the podcast, we're going to break down a little bit more on picking markets and what to look for, and the things to be considering when you're picking a market, to make sure you're picking the right market for your investment goals, and picking a market that is poised for growth and for good returns, right? So we're going to be so tune in next week. We're going to be talking about that next week, so to give you some tips on how to do that. We'll expound on that a little bit more. The last thing is to use creative tools. So again, when a market is continuing to rise, it's really easy. You just go out there, buy something with conventional financing, or get hard money loan on it, turn around, add some value with a remodel or something, or even just hold on to it for a bit and turn around and sell it, and you made money, right? Very simple. I mean, that's what investing is really easy when markets are going up. You just buy something and it goes up in value, and then you sell it and make money, right? So not too complicated. In a market that's shifting, in a market that's going down, Now you have to start to use some creative tools. So we're talking seller financing, options, lease options, delayed closings, all sorts of different tools you can use to really get a different deal structure together that's actually going to work versus like, hey, I have to buy this at a discount to make money, right? Seller financing, there's so many terms you can create. You can, interest rates, interest-only payments, delayed payments, all sorts. You basically, it's not like going to the bank and saying, hey, I want a loan, and they're like, okay, well, here's the terms of the loan, take it or leave it, right? You can get super creative with seller financing. Down payments, all of that stuff is negotiable. So you can create a deal that works for the seller and that also works for you, and it's going to be more conservative maybe, and give you some more options than if you were to just go get a bank loan, right? So that's a huge tool and something to consider. And there's going to be sellers more open to that as buyers are less likely to be vying for the same property, lots and lots of buyers for the same property. That's going to open up opportunities to come in and provide some options and actually have a conversation with the seller, and say, hey, and honestly, not just this works better for me and this has to work this way because that's the only way I can make it work for my end, but really actually having that conversation with the seller that it might actually be in their best interest to do it that way. And in the last few years, they wouldn't have even had that conversation because everybody was just jumping on and bidding on the property, and they're just taking a deal because they don't know any better and they're not willing to have that conversation, or they don't think they need to have that conversation, and they actually could be missing out on a better deal because of so many buyers vying for the property, and they don't have the opportunity for a longer conversation with someone that is trying to consider their interests and give them a deal structure that is actually better for them. Lease options are great. You can tie up and control the property, and maybe even get a sublease agreement in there, right, to sublease it out and continue to make that payment. A seller that's maybe in a bad spot there, they moved and they don't want to, maybe they're underwater. I don't know. I don't think there's gonna be a lot of that, but right, because some people have so much equity right now, but providing a solution where they don't have to manage a rental if they don't want to, but they don't have to, they've got income coming in. You're taking over, the maintenance and all that sort of thing, and they're just getting their payment, but they don't actually have to manage a rental. So lease options are great, and it extends, you don't have to come up with nearly as much cash, right? You can come up with just, a deposit and your lease payment, and it doesn't matter. It could be just a single family home. It could be something that you're working on developing, maybe splitting some lots out, and it's a good structure because it takes maybe expenses off the table from the seller, but it gives you control of the property to be able to do what you need to do, and get it down the road without having to put all of that cash out there up front. And same thing with just an option. So you can do it as a lease with an option to buy, or just an option. And just if you don't know what an option is, basically an option is you're coming up with an agreement on a price, terms, things like that are acceptable to both parties. You have a window of time where you have the right but not the obligation to exercise that option. So you define that option window, when that is it 6 months down the road, is it between 6 months and 12 months, whatever that window looks like, where you say, yes, I want to exercise my option. And then you put a deposit down as option consideration, but you don't have to perform on it. You can say, no, never mind, this doesn't work. You're not obligated to buy it. It's your option to buy it at that price. So that's a really, really good tool to control property without a lot of money out, to be able to maybe do some entitlements and things like that. In the meantime, create some value, but not put all that money out up front. I really like that tool. And from a mentor of mine, that a really good twist on that is you do a lease option where the strike price, or the price at the time of exercising the option, is whatever the outstanding principal balance of the loan is. Now, obviously, it's got to line up with what your price that you're paying for it is, and your down payment and all that stuff, for that to make that work. But it works really well with people that maybe they don't have a lot of equity, but they have to maybe move out of state or something, or for whatever reason they just they have to move from the property. and they don't want to manage a rental, but they can't really sell it because they're underwater. But so what you can, or they're going to lose a little bit of money or break even or whatever, right? They don't have the ability to sell, or the desire to sell, for whatever reason. But you can take over the payments, essentially, is what you're doing, in that way. But you are taking that essentially off their plate, so they don't have to worry about it anymore, and you're going to take on basically the role of an owner without actually having ownership. So you should get the benefit of the amortization at that point. And this is typically, you're looking at like a long-term lease option on something like this for it to make sense. But if you're going to have a lease option that's a really long window, and you're like between 5 and 7 or 10 years or whatever, then that's a lot of amortization that's going to happen over the time, and probably a lot of appreciation. So in that structure, that works really well because you're getting the benefit of the amortization and the appreciation while you're taking that burden off of the seller's plate. So little twist on the lease option that I really like. It has to be the right scenario, but it definitely can work. And then, all sorts of other things, delayed closings, two lump sum payments. Just get creative with what you can put together. Don't get boxed into just your standard financing and having to go out and get a loan. There's so many ways to create a deal, and you just have that conversation with the seller and figure out what they're looking for. Figure out what you guys can put together. You're on the same side of the table, not the opposite side. Okay, and we'll talk about negotiation more down the road as well. You're trying to solve a problem together. You're not against each other. So how can you solve both your problems in a way that works for both of you? Get creative. Last little note, again, I'm not gonna, with the caveat that, again, everything's local, right? I'm not saying we're in a down market. I do think there are markets that got overheated and that are starting to pull back on pricing. But I also think there's plenty of markets that are going to continue to see market appreciation and rent appreciation over at the same time as other markets are pulling back. That's where we're at in the market. Interest rates have continued to go up. It is kind of pulling the rug out from the markets that didn't really have, and exposing markets that didn't really have the drivers behind what was going on with the market appreciation, and it's exposing what markets are solid and have the drivers to have continued growth, even with those interest rates going up and pulling back on buyer activity. So it's actually a really good time to be paying attention to what markets are being affected in what way, because that's a really good indicator of which markets were strong and which ones really just had other things going on that were really not strength in the market. It was just something maybe temporary. But a market downturn, if you are investing in a market that is going to get maybe have some of that pullback or is going to get hit a little bit with a downturn, and even the markets that are doing well are going to do worse. It's not going to be quite as crazy as it has been the last few years, right? So what that means, though, is that there is going to be more opportunity. It's been really tough as an investor buyer over the last few years because there's so much competition. There's so many buyers vying for the same property. Something hits you got to get in before anybody knows about it. Otherwise, if it's on the market, it's too late. It's going to get bid to a number that just doesn't make sense. There's so much speculation going on. So a downturn in the market is not a bad thing as an investor. It is only a bad thing if you let it stop you from investing. If you let it stop you from investing, then it is a bad thing. But it can be a very, very good thing if you are aware and you have the right tools and you have the long-term perspective and you know how to put deals together, because now there's going to be less competition. There's going to be more sellers that are willing to have a conversation, and you're going to be able to have more time with them versus hey, I've got 8 other people knocking on my door to buy my property. Do you want it or not? They didn't want to have a conversation. Now let's have a conversation about what this looks like and put together a deal that works for you and that works for me, and that gets everybody from where they are to where they are wanting to be. So I think it's going to be a great thing. It's going to give more opportunities out there. It's there's going to be investors, there's going to be buyers that drop out of the market. Don't be one of those. But that is going to create less buyers and some more open sellers to talking about ways to put deals together. Is going to create more and more opportunity for us. So stay the course. Always keep looking at deals. Underwrite wisely. Be conservative. Have your tools ready to go in your mind. Know them well. Know how they work. What situations what each tool works best in. Understand sellers' needs and help them get where they're going. Be strategic. Be picky. Be conservative. But don't stop investing. So that is my advice for this market. Is yes, there will be markets that are going to go down. Yes, there's going to be markets that are going to go up. Know what your market is doing, the markets that you're involved in, adjust accordingly if necessary, and continue to buy real estate. And don't buy into all of the media hype about the market crashing. Do due diligence, know what's going on, but don't let it stop you from buying. Don't let the self-talk and the media talk get in your way. Just go out there and make it happen and keep investing and make it happen. So until next time, again, next week, we will talk more about how to look for and pick the right markets to invest in and what key indicators to look at. So definitely tune in to that episode. It's going to be, I think, even more important to consider those things as we're moving forward here in the next couple of years. Until then, make it a great rest of the day.